Hey there, welcome back. This lecture is going to be on the PSAR. The PSAR, PSAR, stands for Parabolic Stop and Reverse. This indicator plots dots above or below the price, indicating a trend. If the dots are below the price, then it indicates an upward trend. If the dots are above the price, then it indicates a downward trend. It works great in trending markets, as most indicators do, but it does not work too good in choppy markets. For that reason, we need to use it with other indicators. Another one we could possibly use is the moving average, a simple moving average of 50. Say if the angle of the moving average is sloping down, then only take trades to the short side. If it's sloping up, only take long trades. Or you could use it with psychological levels, the whole numbers, half numbers, and even support and resistance levels that you've identified. You could even add an ADX indicator to this. The ADX we're going to get into in a later lecture. But back to the PSAR, we're going to go over the calculations. Actually, I'll just put them up here. The platform will do all the calculations for you, as always. It has two settings. The first one, the default is 0.02, and the second setting is 0.2. The first setting is the step, and the second setting is the max step. If you increase the first setting, the 0.02, then that will make the indicator more sensitive. If you leave it where it's at or reduce it, then it'll make it more smoother. So that first setting is the acceleration factor, and the second setting is the max of that factor. A lot of people use the PSAR dots as stop losses for their trend trades. How this works is when the price comes back to the dot, then you close your trade. So every new candle, you'll move up your stop loss, adjust it to where the new dot is. So let's go ahead and put it on the chart so we can all see it. It's also included with the platform. So just double click in the indicators folder, and then you can edit. And as you can see, the defaults are 0.02 and 0.2. You could also add the filter of the SMA 50, the simple moving average. So with this filter, when the angle of the line is up, sloping up, then we only take long trades. When the angle is sloping down, then we'll only take short trades. That's going to be it for the PSAR. You can mess around with it and see what other indicators you can use in correlation with your trading. In the next lecture, we're going to go over Fibonacci. All right. Hello, welcome back. This lecture is going to be on the Bollinger Bands. John Bollinger developed the Bollinger Bands in the 1980s. The Bollinger Bands plot lines on the chart that are a standard deviation from a moving average, one standard deviation, 2 or 3. One standard deviation would be fairly close to the moving average. 2 standard deviation, which is the default, would be a little further than that, and 3 standard deviation would be very far from that moving average. Normally the price stays within the 1 standard deviation about 69% of the time, and it stays within 2 standard deviations about 95.9% of the time. And within 3 standard deviation, the price stays in that range about 99.7% of the time. The moving average line that it's based on can be adjustable. The default is 20 for the moving average and 2 for the standard deviation. So how do we use all of this information? Well, we could wait for the price to approach these lines or pass it, and then enter a trade the other way. This would be a type of reversal or range-bound trading. We could combine other indicators, such as the moving average line of say 50. When it's on the same side, then only take trades in that direction. We could add a stochastics indicator also. To use that, we would wait for the overbought and oversold areas of that indicator, and then when the lines cross back over the overbought and oversold areas, then we would enter our trade. Now with these standard deviation lines on the Bollinger Bands, those are considered overbought and oversold areas as well. So as we said, the Bollinger Bands is good for range-bound trading. They can be used with trend trading also. To do that, we would go with a squeeze play. The squeeze play is when the lines are constricted, squeezed together, and then the price is bound to shoot up in one direction or the other. The trick is knowing which direction that's going to be. Now be careful when picking this direction, because the market manipulators like to spike the price in one direction, but the true move will be in the other direction, stopping you out of your trade. One way to overcome this is place a trade or place an order on both directions. We would use stop orders for that, a stop buy on the top side and a stop sell on the bottom side. And well, you're probably thinking, well, one trade is going to lose, right? That's true. But to get over that, we would change the take profit to 2 times the stop loss amount. The stop loss amount would be the other line of the Bollinger Bands. Now let's go to the platform so we can see how this works on the chart. This is included with the platform, and to put it on the chart, just double click it. It's called Bands on this platform, and just use the default settings of 20 and 2. And then we'll add a filter of a moving average of 50. We wait for price to close beyond the outer lines, and if it correlates with the moving average, then we have a good setup to enter a trade the other way. For the squeeze play, we would wait for the bands to narrow, squeeze together, and then we know price is going to shoot up one way or the other. So what we would do is place an order in both directions. Place a stop order going long, place a stop order going short, and set the take profit twice the size of the stop loss. The longer the squeeze, the more effective this method is. To make trading with the Bollinger Bands easier, I've included an alert indicator in the resources section of this lecture. What that will do is send you an alert, an audible alert, and a pop-up window when price reaches one of these outer lines. To apply it to the chart, just double click the indicator and it's active. You can adjust the settings to whatever your settings are for the Bollinger Band that you apply to the chart. This way you don't have to constantly stare at your screen, and it would make trading a little more enjoyable. That's it for this lecture on the Bollinger Bands. In the next lecture, we're going to talk about the ADX. See you there. Hey there, welcome back. This lecture is on the ADX. The ADX stands for Average Directional Index. If you follow along in your book, just turn to the page, the ADX page, and it looks like this. And we'll put it up here for you. There's 4 components of this: the ADX line, the positive DX, the negative DX, and the level, 20 level or 25 level. When the ADX line is above that level, then we're in a trend. When it's below, then we're in a choppy or sideways market. So how we use this information is we could add another indicator such as the stochastics, and then every time the ADX is above the line and we're in a trend, first we identify which direction the trend is. To do that, you look at the minus DX and the plus DX. If the plus DX is above the minus DX, then we're in an uptrend. and vice versa for a downtrend. So once we've identified the trend, and then we look at the other indicator, if we added a stochastics, then we would look at that. We would wait for, say if we were in an uptrend, then we will wait for the stochastics, which is an oscillator, to get to the oversold area, and then we would enter a trade to the upside when it comes out of that area. Now there is a more aggressive way to use the ADX indicator. We look at the angle of the ADX line, regardless of where it's at relative to the level, the 20 or 25. And if the angle is up, then we're in an uptrend. If the angle is down, we're in a downtrend. But remember, we also look at the DX lines, the minus DX and the plus DX. When they're separating, then the trend has begun. When they're converging, then the trend is ending. Now let's apply this to our charts so we see how this works. Now to match it up with the chart on our infographic, we want to change these levels. We want to change the 20 level to a 25 level, and let's also add a 50 level so we know when the trend is very strong. So now as you can see, the line crossed over the level and we're in a trend. The market is trending nicely, and then it has crossed over the 50 level and now we're in a strong trend. And then we add these stochastics as a confirmation for our trade entries, and then we wait for it to reach an overbought or oversold level, in this case the oversold. And then once it gets out, we enter the trade to the long side. And let's look for one going the other way. And there's one. We have a trend going down. The ADX line is above the level. Trend is confirmed. We wait for the stochastics to give us a signal, and there it is. And we take the trade there. All right, that's it for the ADX indicator. In the next lecture, we're going to go over the Ichimoku. See you there. Hey there, welcome back to the course. This lecture is going to be on the Ichimoku. So if you're following along in the book, this is going to cover 2 pages from it. The first one will be Ichimoku and the second will be trading the Ichimoku. So we'll put the first one here. The full name is Ichimoku Kinko Hyo. I don't know if I'm saying that right, but that's what it is. And what it means is, the first word Ichimoku means a glance. Kinko means equilibrium, and Hyo means chart. So it means a glance at a chart in equilibrium. The Ichimoku can be used for many things in trading: trends, momentum, support and resistance, entries, exits, stop losses. So you could say it's an all-in-one indicator, and a lot of traders use it exclusively. The colors could vary depending on the settings, but here we're going to use these colors for the lines. The Kijun Sen is the blue line, the Tenkan Sen is the red line, the Chikou span is the green line, the Senko span is the cloud, which is represented by the shaded orange area. The default settings are 9, 26, and 52, and we're going to stick with those. The first one, Tenkan Sen, which is the red line on this infographic, that is the average of the highest high and the lowest low over the 9 prior periods. When the line is angled, that means there is momentum. When it is flat, that means the market has no momentum. The next line, the blue line, is the Kijun Sen. It is the average of the highest high and the lowest low of the last 26 periods. This measures medium price term momentum, and this Kijun Sen can also be used as the support and resistance line and also a stop loss area. You could just trade the crosses of these 2 lines, which is called the TK cross, and just use the line that's further away as your stop loss. Now the Senko spans A and B, the area between those, they form the cloud. That's why it's referred to as the Ichimoku cloud. The A line is the same as the Tenkan span, except that it's shifted 26 periods ahead. And the B line uses 52 periods, but is also shifted 26 periods ahead. The cloud can also be used as a support and resistance area, especially on the flat areas when one of the lines are flat for a while. That's a good level of support and resistance. And they present trading opportunities when the price breaks out of the cloud. The Chiku span, which is the lagging line, and it's green on this chart. This is the current price shifted back 26 periods. What this tells us is if we should take a trade based on the other two entries, the TK cross or the breakout of the cloud. How to use it is you go back 26 periods, and if it is touching any of the price back there, then you don't take the trade, because that would mean the market is still in a range. But if the line is above or below the price, then you would enter your trade. So basically it means if the price is in the same area that it was 26 periods ago, then we wait for a trade. So this Chiku span, the green line, also tells us whether the market is ranging or trending. A more conservative approach would be to wait until it breaks out of the cloud also. The Ichimoku works well in most of the time frames, but it works better in the longer time frames, just as 4 hours or the daily charts. And then you get the added benefits of stress-free trading. You don't have to stare at your charts all the time. Now let's put this on the MT4 platform and see if we can locate some of these trading opportunities. This one is included with the platform, so just double click in the indicators folder and we got it there. And if you're just trading the TK crosses, you would place entries there and there, but you want to filter them out with the Chiku span. You want the Chiku span, which is the lagging line, to be past all 4 areas of support and resistance. The 4 areas are the Kijun Sen, the Tenkan Sen, and the 2 lines that make up the cloud. So another way would be once it breaks out of the cloud, we wait for a retrace back over the lines, and then when it comes back through that, then when we have a good opportunity, and if it's not filtered out by our lagging line, then we enter the trade. And you can set the Kijun Sen, the one that's set on the 26 periods, as your stop loss area. Once it breaks that, then you get out of the trade. If you just go back through the charts, do a little back testing, you can see that these flat areas do form good support and resistance areas. So with this Ichimoku Kinko Hyo, you can have both a conservative approach and an aggressive approach. The conservative approach would be when all 4 lines are broken, and the more aggressive approach would be only when the TK line is crossing. Again, a lot of traders use only this Ichimoku cloud in their Forex trading, and with good money management, which we'll get into in a later lecture, you can have a pretty profitable system with just this Ichimoku thing. That's it for this lecture. In the next one, we're going to go over chart patterns. Lots of chart patterns. See you there. Hey there, welcome back. This lecture is going to be on chart patterns. This is going to cover 4 pages in your book. Lots of patterns to go over. Let's start with page 1 of chart patterns. The first pattern is the double bottom. It forms 2 bottoms at roughly the same support level, and it has a neckline of the high between the 2 bottoms. This indicates prices are going to rise after the double bottom is completed. And then you have the double top, which is the opposite of the double bottom. You have the head and shoulders. As you can see, it has 2 highs that look like shoulders and another higher high in between them, and that's the head. The neckline is where you would place your entry, or you can set a pending order. And then you have the inverse head and shoulders, which is the reverse of the head and shoulders. On page 2, you have a rising wedge continuation pattern. The market falls, then forms a small wedge, and then continues to fall. The little yellow brackets there are where you would take your profits. The size of the wedge would equal the amount of the profit. Next to that, you have the rising wedge, but a reversal pattern. This forms a wedge, but it reverses after the wedge when it breaks down to the other side. And you have a falling wedge, continuation patterns, and reversal patterns. Falling wedges are angled down and either continues or reverses after that. What to keep in mind about these patterns is as these two lines are coming together, you know the price is going to shoot one way or the other. So you can determine which direction better by looking at the trend on a higher time frame, and that's going to give you some indication of whether it's going to fall or go up. On page 3 of the chart patterns, we have a rectangle formation. This forms a support and resistance area, a ranging area. You draw a support at the bottom and a resistance line at the top. This could either be a bullish continuation or a bearish continuation, depending on which side it breaks out. Below that, you have the pennants. This also could be bullish or bearish, depending on which direction it breaks. On page 4 of the chart patterns, you have triangles. These form triangles, and then they break out after the triangles complete. The further the price action goes into the triangle, the bigger the breakout is going to be. Again, these expected gains are just suggestions. You can choose whatever you want based on your own strategies. After a while, all of these chart patterns are going to look similar, but the key takeaway from all of this is that you're going to have two lines that come together, and once the break happens, it's going to shoot one way or the other. The only difference is the rectangle pattern, which are two horizontal lines. Now let's go to the MT4 platform and see if we can identify some of these chart patterns. Here's one here, the double bottom, and here we have a head and shoulders. Here is a falling wedge pattern, and here is a rectangle, a bearish continuation pattern. To delete these lines from your chart, just right click on the chart and then choose objects, and then click on one and then delete. You can delete them all if you want. Here we have a pennant, a bearish continuation pattern, a falling wedge, a continuation to the upside, and here is a triangle, a symmetrical one. And just as a caution, don't use these patterns solely in your trading. You want to combine them with other strategies to have a full system. That's it for chart patterns. On the next lecture, we're going to go over pivot points. All right. Hey there, welcome back. This lecture is going to be on pivot points. The pivot points indicator draws 7 lines on your charts. One line is the pivot point line, which is in the middle. Then there are 3 lines above it and 3 lines below it. These lines can be used as support and resistance, take profit areas, stop loss areas. As you can see on the infographic, the first line is the pivot point line, labeled PP. This is the high plus the low plus the close divided by 3. The first line above that is the R1 line, or the resistance 1. It is 2 times the PP minus the low of the previous day. This is if you're using a daily pivot lines. If you're using weekly ones, then it would be the low of the weekly. The first line below it is the support 1 line, or S1. It is twice the PP minus the high of the daily if you're using the daily pivot lines. Most pivot lines are based on the daily. They are daily pivot points, and there are weekly lines or monthly lines just depending on what type of trader you are, swing trader or position trader, day trader. If you're a day trader, you want to stick with the daily pivot lines. The second line above the PP line is the R2 line. That is the PP minus the S1 plus the R1. The formulas for the other lines are here on the infographic if you are interested in how they are derived. These lines give us an estimate of the highs and lows of the day. One study suggested that the S1 and the R1 are exceeded only 44% of the time, and price exceeds S2 and R2 only 17% of the time, and it exceeds S3 and R3 only 3% of the time. So knowing these probabilities, you can be more confident when placing your stop losses and your take profits. You can also use pivot points with other indicators. Let's add the RSI to the chart. To do that, let's go to the MT4 platform now. The pivot points indicator is not included in the default indicators that come with the platform, so we will have to add it. As before, just download it from the resources section. There will be 3 of them, one for the daily, the weekly, and the monthly pivot points. So just put them in your indicators folder under the MQL4 folder, then restart the platform, and under the indicators, double click on the pivot daily, monthly, weekly. You can tell the difference between them because the daily pivot points cover a single day, the weekly ones cover a whole week, the monthly ones will cover an entire month. Just like the Fibonacci levels, these are used as support and resistance. They are actually called resistance 1, support 1, and so on. To add the RSI indicator, just double click it and use the default settings. Right off we can see that there is a divergence. We'll be getting into more detail on a divergence in a later lecture, but for now you can see that the peaks are diverting from the peaks of the price. So we'll draw a line here from this peak to this peak, and draw a line here from this peak to this peak, and you can see that the angles are different. So in that case, we'll place a trade here going to the downside. You can get in the trade at one of the pivot lines, and you can exit the trade at one of the pivot lines. So just do some back testing on this strategy and see if it works for you. And that's it for this lecture on pivot points. The next one will be on Elliott wave theory. Okay. Hey there, welcome back to the course. This lecture is going to be on the Elliott wave theory. This is going to cover 2 pages from your textbook. The first page is Elliott wave theory, and the second page is trading Elliott waves. So let's put the first one up now. The Elliott wave theory is based on the research of Ralph Nelson Elliott. He realized that the market moves in a series of waves, 5 waves to be exact. These 5 waves are marked on the infographic. What we're looking for is trading waves 1, 3, and 5. These are the waves that move with the trend. Waves 2 and 4 move against the trend. After this 5-wave move, there is a 3-wave move going the other way, and those are marked A, B, and C. The theory states that there are smaller waves within these larger waves, and those smaller waves have smaller waves within those as well. It's best to trade only during the impulse waves, as you will be following the trend during those trades. There are some rules that we have to follow this theory, and the first one is wave 3 cannot be the shortest impulse wave, and wave 2 can never go beyond the start of wave 1, and wave 4 can never cross into the area of wave 1. If any of these rules are broken, then it's not a valid Elliott wave, so keep looking. Some other pointers to keep in mind is that wave 2 usually retraces 50% into wave 1, and wave 3 moves 161% of wave 1. Wave 4 usually retraces 38 to 50% of wave 3, and wave 5 is usually the same length as wave 1. If you haven't noticed yet, these are Fibonacci numbers that we are using, and you are familiar with them already from my previous lecture. So how we use this is to trade the waves 3 and 5. To do this, first we have to identify wave 1. Then ideally we want to buy at the bottom of wave 2, which means we'll be trading wave 3. You could take your profits at the top of wave 1 and set your stop loss at the bottom of wave 1. This example is for a long trade going upward. For a short trade, you would just do the reverse. That take profit is a conservative one. You could use a slightly more aggressive one. That would be to trade the entire length of wave 1. So let's see if we can identify these Elliott waves on our platform. This indicator is not included with the default indicators of MT4, so I've included one for you in the resources section of this lecture. Just like before, double click it and apply it to the chart. This plots all 5 waves when they are identified by the indicator. So how we would use this is we would wait for the 5 waves to complete, and then we would trade the corrective waves, A, B, and C. So we would wait for the price to move away from the 5, the number 5, and then wait for a retracement. The retracement level we want to be about 61.8%, which is one of the Fibonacci numbers. Set your stop loss at the 5 or just beyond it, and your take profit would be where the retrace started. Try it out, and maybe it's something you want to include in your arsenal of strategies. Or maybe it's not, but either way, you now know what Elliott waves are. That's it for this lecture. On the next one, we're going to be going over how to determine if the market is trending or ranging. See you there. All right, welcome back. This lecture is going to be on trending versus ranging. Knowing when the market is trending or ranging will help you a lot in your trading. Some strategies work well in ranging markets and others work well in trending markets. You only want to trade in the type of market that your strategy is suited for. In this lecture, we're going to look at 3 different ways to determine whether the market is trending or ranging. If you're following along in the book, the page is called Trending versus Ranging. Now, all 3 of these ways we've covered before in earlier lectures, so you're going to be familiar with them, but we haven't really covered whether it determines if the market is trending or ranging. Maybe one of them is like that. The first one we're going to look at is moving averages. Plot 3 moving averages on the chart: a 7, simple moving average, a 21, and a 63. Or you can pick numbers that are close to that, as long as you have 3 there. Now, when all 3 of these lines are diagonal, then you know you're in a trend. If they are fanned out, that's a good indication also. If these lines are flat or if they're crossing each other a lot, then you're in a range. Let's look at the ADX. We've used this before with the 25 line, and we're going to continue to use the 25 line to determine whether the market is trending or ranging. Basically, if the ADX is above this 25 line, then you're in a trend. If it's below, you're in a range. Next, we're going to look at Bollinger Bands. With this one, we're going to set another standard deviation of 1 as opposed to the standard or the default of 2. So the price will come within this standard deviation of 168% of the time. So from that, we determine if it's outside of this range, the standard deviation of 1, then you're in a trend. And then when it comes back inside this 1 standard deviation, Bollinger Bands, then you're in a range. So in that case, you would want to use your range trading strategies. and just wait for the price to come out of that one standard deviation range, and then you're in a trend. If you want, you can combine all three of these for more confirmation, or that will just give you more noise on the chart. It's up to the individual trader how he likes to trade. We don't need to put these on the chart since we've covered them already. You should already know how to apply them to your charts. If not, then just rewatch the previous relevant lectures. There are other ways of determining whether you're in a range or a trend. The simplest way is to just look at your chart. If price started here and the price ends up here, then you're in a trend. If the price is here, it goes back and forth and you're still in the same area, then you're in a range. That's it for this lecture. In the next one, we're going to go over whether a move is a retracement or a reversal. See you there. Hey there, welcome back to the course. This one is going to be on retracements and reversals. Knowing when a move in the market is a retracement or a reversal is important when deciding whether to exit your trade or not. The analysis in this lecture is mostly subjective. A lot of the technical indicators are that way. So one trader might come to a different conclusion than another trader, but let's get on with it. Anyway, first of all, what are they? A retracement is a short-term move in the market based on technicals, and they usually occur after a big move, as opposed to a reversal, which is a longer-term move in the market. The reversals are based on fundamental information, and they could occur at any time. Now, to identify which is which, some use Bollinger Bands, some use support and resistance levels, and others use trend lines. In this infographic, we are using support and resistance levels of the pivot points and Fibonacci retracements, and also trend lines. As you can see, if they bounce off these levels, the Fibonacci retracement levels or the pivot points, then most likely it is a retracement. Trend lines, when used in higher time frames, would give us a better indication if it's a reversal. If it bounces off the line, then it's a retracement, and if it breaks the trend line and that break is confirmed, then most likely it is a reversal. Be careful with these breaks of the lines. The market makers like to spike the price, fooling traders into thinking the market is going one way when really it's going the other. As you can see in the trend lines box, the white circle area, the price has broken. It has come down and retouched the price and then shot up there. So that would be a confirmation of a retracement, a true retracement. And when using Bollinger Bands, it's not on the infographic, but I'll mention it anyway. The price, when it is for some time outside of the bands and then it comes back into the bands, that signals a reversal. But just make sure the Bollinger Bands are used on a higher time frame. You could also look for chart patterns, the ones that take a long time to develop, such as double tops or the head and shoulders patterns, and you'll know what they look like from the previous lecture on chart patterns. That's it for this lecture on retracements or reversals. The next one, we're going to go over harmonic patterns, more patterns. See you there.